Welcome to the No Unfinished Business podcast. There are 1,000 different ways your clients can leave unfinished business, but no single advisor can address every issue. In every episode, we'll answer the important questions to help professional advisors focused on individual clients. Attorneys, CPAs, and financial advisors identify and eliminate those planning blind spots so you can speak competently and confidently to your clients and help them leave no unfinished business. Hey, Dan, thanks so much for joining me today.
Hi, John. Thanks for having me on. Appreciate it.
Yeah. So, Dan, we met a few months back, and I thought when we were sitting there talking, you've got an interesting business where you're helping folks invest in something that they probably didn't know was even an option for them. And I was like, well, here, let's find out a little bit more about some of these alternative investments that aren't the ones that are necessarily grabbing all the headlines, crypto and all the rest of the foolish things that are out there. Dan, what do you help people do?
Yeah, so I help people with investing in mortgage notes. So what mortgage note investing is basically buying someone else's mortgage and then either collecting the payments and basically functioning as a bank. So really it's an alternative form of real estate investing. So the way that I found it initially is I was looking at single family rentals, right? So if you think about you buy a single family rental, you're making some down payment, you're hiring a property manager, you're collecting some monthly income stream. Buying the mortgage is similar to that in many ways, with the exception is that you don't actually own the property, right? So you're more like the bank. You're just owning the loan so you can collect that payment stream, but you're not necessarily on the hook to do things that a landlord would do, like fix toilets, answer calls in the middle of the night, things like that. So
Yeah, and how do you even get started in investing in something like this? Because it seems, somebody made the initial loan. You're not making the first loan on the property. It sounds like you're taking over for somebody else.
yeah, you actually could do either.
Okay.
For the most part, when I buy mortgages, I'm buying them from either individuals who already own them. I'm often buying them from smaller hedge funds, things like that. You can buy directly from banks. Like when a lot of people hear of this, they assume they're going to go to the bank and buy one. That's actually fairly challenging unless you happen to already have a relationship with that bank. Generally, like your banks, like here in Colorado, where I am, if they have a loan and let's say it becomes distressed or they want to get rid of it, either they're going to take care of that themselves or they're selling it like to a larger hedge fund. So they can come from people who already own them. They can come from smaller funds who maybe bought them. So these things are often sold off in big pools and then they kind of filter down through the ecosystem. So there might be like a really large bank or hedge fund that buys this big group of loans, sells it to a smaller fund, and then it can kind of make its way down to you as an individual. But then there's also this entire space, seller finance notes. So what happens in seller finance is, let's say I have a property, I want to sell it. Maybe it's rural, or maybe I want to sell it to someone who can't get a loan from a bank. Then I can originate my own loan so that basically then I sell my property, I act as the bank. And then to get cash, then maybe I turn around and sell that loan to somebody like me that wants to hold the loan. So they can come from multiple places. I'm generally not originating them myself. Where I do sometimes end up originating them is because I'm acting as a bank, right? And if the borrower doesn't make payments, then I also have the right to foreclose. And even though I go out of my way not to, occasionally I take some of these through the foreclosure process. Now I end up with the property, which I didn't want. I wanted the note. And so sometimes I'll sell the property on seller financing and then create a new note for myself.
Okay.
So for such a small niche area, there are a lot of different ways that you can play in the space, and there's a lot of room for creativity.
Yeah, and so just thinking about, well, if somebody were interested in it, I mean, the idea is here we're getting hopefully low investment, low, almost as close to passive returns as we can think about, because somebody should just be paying you back the money you've effectively loaned them. What
Hmm.
does it take to get started in this, other than having money to loan?
Yeah, so there are a couple different ways that you can attack it. Generally the way people get started, like the way I got started, was I used some of my money from a self-directed IRA to buy. So, most people have some other retirement accounts, like you can move some of that to a self-directed account and then buy some performing loans. So now if you're going to do this there's a couple ways you can approach this. If you're going to do this as an individual, I highly recommend getting some form of training in that. And there's another number of options out there. There are online courses, there are live trainings available. Costs on that vary wildly, because what you do need to do when you go into this, it does have some nuances that you need to understand. So you need to understand like a very good due diligence process. So you got to
Right.
understand how to value the loan. You got to make sure that the title is clear. Like there are bad actors running around who will try to sell you a loan that maybe hasn't received any payments for 10 years and is outside the statute of limitations, and you
Hmm.
can't foreclose, or there's some title flaw. So you got to understand how to spot those things and navigate those. And part of my process, and what I always recommend to people too, is when you get all through it, is have a real estate attorney in that state review the chain of title and the documents to make sure that that's okay. So if you're going to go the individual route and buy on your own, you want to do some amount of training, decide like what account you're going to use, whether that's a self-directed IRA or whether you're going to set up an LLC or you have some other entity that you like to use for real estate investments. The other thing people can do is there are a number of mortgage note funds out there, some big, some small, that offer a variety of different terms. And I'm not sure where all of them are now. I know at one point last I checked, like a lot of them were paying like preferred returns of like 9 to 10%, which
Hmm.
is not bad considering we've had this run up in property values over the last several years. So like a lot of these loans that you buy have significant equity in them, which is nice because it de-risks you as the investor. So if you do have to go and foreclose on a note, or if it's a note that's part of a fund that you've entered into, you can really cap your downside a good bit by doing that. But again, like mileage varies a lot depending on what kind of loans you want to buy. If you're looking for stable performing loans that are high quality, you can do it with a fair low amount of risk. And then there's this whole other end of the spectrum which you can play in, which is not for the faint of heart, to be quite honest, which is the, very distressed ones where you're taking the foreclosures. And I've done a bunch of those, and those get wild. Like you can hit big home runs with massive returns, and you can also get upside down, which I've definitely done on a few of them.
Yeah, I guess the due diligence part is where I start thinking about how scared I am. I'm not good at running anybody's credit. How am I going to figure out if this person whose loan I'm potentially taking over on, how, what sort of training do you get on running credit and doing things like that for folks?
Yeah, so the way I do it, right? Because typically I'm not now. If I am originating, I have an underwriter that I use,
Hmm.
and they collect the Fannie Mae form and they make sure that the loan is Dodd-Frank compliant and they handle that. But the majority of time, I'm buying loans that already exist. And
Okay.
so when you're buying the loan, one, you can't talk to the borrower, right? Because it's like, I don't know if people listening, I know I've had this where the loan on my primary home was sold. Like I bought a house 2 years ago. This one bank originated it, and then they sold it to Chase Bank, but Chase never talked to me in the process of them
Hmm.
buying that loan. And so for existing loans, I don't so much worry about the borrower themselves. Sometimes you can get the origination documents and understand like what was submitted and where their credit was at the time it was originated. What I look at and focus on mostly is the payment history on the loan. So have they been making payments? How reliable are they? What have their actions been? And
Hmm.
then what's the value of the property relative to the loan balance? So, like in a scenario where I do have to foreclose, how much room do I have to work with? Some people who buy these get big into trying to dig into the borrower's background and Facebook stalking and this and that. But honestly, like I don't know enough to judge by that kind of stuff, whether someone wants to stay in their home and they're going to make payments or not. I found that a lot of that stuff is really impossible to predict ahead of time. So I just kind of look at the borrower's previous actions and then just the value of the property.
Got it. As we're thinking about it, obviously there's risks of people non-paying. Any other risks that people should be aware of beyond just you'd mentioned also title issues, but what else is out there that could ruin an investment?
So the big one is if you do have to take it through foreclosure and the borrower decides to fight you on it, that can get very open-ended and nebulous and scary. So that's why there are specific states I stay away from
Hmm.
that are a higher risk from that. So like New York, New Jersey are pretty big examples. Like in those states, if a borrower wants to fight a foreclosure, they can keep it tied up relatively easily for years on end. Like Cook County specifically in Illinois,
Hmm.
in Chicago.
Right.
Pennsylvania is a bad one. But then, so part of it is staying in states that have a good supply of notes and are relatively straightforward to work with. Like Michigan and Indiana are like two of my sweet spots.
Hmm.
And there are a bunch of other states as well. But that's another good way to run into trouble.
Other than that, talked a lot about the downsides. What other than cash flow, any other big upsides to think about with this?
Yeah. So one is you can basically get higher yields than you can other places. Like it's very straightforward. Like you can go on to online at some online exchanges like paperstack.com and get double digit yields on high quality notes. And they're fairly easy to find. And those are not the best deals. Those are just like the easiest ones to find. If you've built a network and kind of know what to look for, then you can do better than that. So you can get pretty high cash flow yields with equity protection on top of that. And that's fairly unique. The reason you can get that is just kind of a niche market that not many people know how to play in. So that's one of the upsides. The other is these loans typically trade at a discount, right? So maybe the loan was written at 7 or 8%, but you're buying it at some discount to the balance that nets you out, say, a 12% yield. Then the other upside is getting an early payoff, right? So let's say it's a, just making up numbers, a $50,000 balance loan that you buy for 40,000. If the borrower is able to get refinancing or they just decide to pay it off, then you would collect that $10,000 difference like right off the bat. And I've had a few where I've bought the loan and fairly shortly afterwards, the borrower decided to pay it off. So that's another really good upside from it. And the other thing too is if you buy the performing notes right, they can be pretty passive compared to like rental properties as well, right? So you would hire a loan servicer that's going to manage the loan, send out statements to the borrower, handle it month to month. But if that loan keeps performing, there's not a heck of a lot you have to do. So you're not necessarily messing with the property manager or doing repairs yourself or other kinds of things like that. So there's pros and cons to all of these.
Yeah, and then as we think about the environment we're in now with higher interest rates, how does that affect this market? Is it just purely more money is available for payments to come in as your return, or do you see more people getting involved? How do you think that changes what this looks like?
You know, it's been really weird. This doesn't make any sense, but I haven't seen a lot of a difference in the note market since interest rates have spiked. I was talking earlier about the seller finance notes. It seems like since like back in the 80s, people tend to originate these things at 9.9% interest rates, 10%. And that hasn't changed a whole lot since, which honestly doesn't make sense. Like I would expect the
Yeah.
note market to loosely track the rest of the market, but because I think it's fairly nichey and these things are also like somewhat illiquid, the market's not as it's not as efficient as other things, which is actually a good thing as an investor, right? Because when I'm buying these things, because it's not a super liquid market, it's not like buying stocks where you can go out and look and say, okay, what's this trading at? What's this trading at? These are very much one-off deals. So what happens is you go and you talk to different sellers, and some of them will want like very high pricing, and then you find one that takes a lower price. So if you look in enough places and talk to enough people, then you can uncover really good deals. So it's your ability to get like the right pricing and do well is more based on your ability to talk to more people and look in more places than say like the stock market where there are these published prices for everything that everybody kind of follows.
Got it. Overall, what do you think the size of this market looks like? Is it just so niche that, there are only a handful of people or thousands of people? What does this look like?
So from what I understand, I'm trying to remember the exact numbers, but there was a report that came out a year ago. So like on the seller finance side, I think there was like close to $1 trillion a year in seller finance notes that are originated, which is like way larger than I would have thought. When I was at a conference from a guy named Eddie Speed, who's he's been at this for like decades and decades, like back, like I think to the late 70s. He estimated there's maybe like 6 or 7 thousand
Hmm.
note investors like me that are like truly active in the
Right.
space. There are a lot more that have maybe bought one or two notes and are holding on to them. So it's kind of a challenging thing to estimate. But what I like about it is when I talk to other real estate investors who are doing rentals or fix and flips, those have been challenging to find, like at the right, especially rentals, like at the right cap rates, especially here where I am in Colorado, because the market's just been tight. Prices have been going up. On the fix and flip side, like COVID stopped a lot of the sheriff's auctions for a while. There hasn't been a lot of good opportunities there, or there's a lot of competition when deals show up. So I really like it because it's a relative to the amount of competition that's out there looking for these things. It's a very large market. So it's much easier to find good deals than in other places. The rub is you just got to be able to do that due diligence, and you got to understand a few things that not everybody's familiar with.
Got it. Last thing before we start closing down. Dan, what's one thing you wish you knew about this when you got started that you learned later than you should have?
I wish I would have understood the value of some of these loans when I started. So when I started in 2017, we were still a little bit in the wake of the financial crisis, and there was a larger supply of these things available and pricing was lower. Me being the conservative engineering type that I am, I kind of went slowly as I learned. I did my first deal and I kind of grew slowly and got more comfortable. Looking back now, those deals that were available were way better than I realized at the time. So what I would have done different was gone back in time and just like absolutely backed up the truck on some of those deals in 2017 and 2018 that are not available anymore.
Got it. Well, Dan, this is a good place to hold up for right now. If anybody's interested in following up with you, where can they find you?
Yeah, so they can email me directly at dan@fusionnotes.com, or you can also check out my website, which is just fusionnotes.com. I'm pretty easy to find out there.
Excellent. Dan, thanks so much for stopping by.
No, thanks for having me on. Appreciate it.
Thanks so much for listening. You can find more episodes, videos, and links to more helpful content at nounfinishedbusiness.com. If you have any questions, feedback, or ideas for topics, please reach out via social media or email john@strohmeyerlaw.com. And of course, if you or your clients need help from John with an estate planning, probate, trust, or cross-border tax issue, you can book time directly with John at askjohnaquestion.com.